On a Friday morning in June 2020, hundreds of thousands of people across Britain tried to buy something completely ordinary: groceries, petrol, a bus fare. And their cards simply stopped working. Not one bank's cards. Cards from 6 different companies, all at the same instant. Some of those people had their wages paid onto that card. Some had their benefits paid onto it. One of the card companies told its customers, in writing, that if they could not afford food while their money was frozen, they should contact their local welfare assistance scheme. A food bank. Almost none of them had ever heard of the company that caused it. It was called Wirecard. And 4 days earlier, it had admitted that 1.9 billion euros sitting in its accounts did not exist. Not stolen, not moved offshore, not lost in a bad investment. It had never been there at all. The largest asset of one of Germany's 30 biggest public companies was a number typed onto a letter. That is strange enough. But it is not the strange part. The strange part is that in the 18 months before this, the German state was not investigating Wirecard. It was protecting it. It banned investors from betting against it, and it reported the journalists who found the hole to the police. And the man who built the machine that invented the money has never been arrested. He is in Russia. He is living under a different name. And 6 years later, he is still there. And he is no longer only accused of fraud. This is the story of the largest corporate fraud in German history. Not because it was clever, it was not clever at all, but because of how many people had a reason to look away. Chapter 1. The layer you never see. When you tap a card, it feels like 2 parties are involved, you and your bank. In reality, there are at least 5, and the one that matters most in this story is one you will never be told about. It is called a payment processor. Its job is to sit between the shop's terminal and the card networks, take your tap, check it, route it, and get the money moving in the right direction. It is plumbing. Plumbing is invisible when it works. That is the entire point of it. And it means a company can become critical to millions of people's daily lives without a single one of them ever learning its name. Wirecard was founded in 1999 in Aschheim, a quiet commuter town on the edge of Munich, to do exactly that job. But it started at the end of the market that nobody else wanted. Ordinary banks refused to process payments for certain kinds of websites. Too much fraud, too many customers demanding their money back, too much reputational risk to be worth the fees. Online gambling. Pornography. According to Der Spiegel, Wirecard's early customers consisted primarily of porn and gambling sites. That was the business, handling the payments the respectable banks would not touch for a fatter margin. It is worth pausing there because it quietly explains everything that follows. A company built on serving customers nobody wants to look at closely learns one skill extremely well: not being looked at closely. Then the dot-com bubble burst, and Wirecard nearly died with it. In January 2002, a 32-year-old Austrian consultant put his own money in and took over as chief executive. His name was Markus Braun. He had come out of consulting, he wore a black turtleneck at every public appearance for the next 18 years, and he talked about payments the way other people talk about a calling. Braun's first significant move was not a product, or a customer, or a technology. It was a piece of financial engineering, and it set the pattern for everything that came after it. In 2005, Wirecard did what is called a reverse takeover. Instead of listing itself on the stock exchange, it merged into a company that was already listed and took over the listing. The company it merged into was a failing call center business called InfoGenie. Wirecard's people walked in, the old business walked out, and the shell kept its place on the exchange. Here is why that matters, and it is not a technicality. A normal stock market flotation forces a company to publish a prospectus and submit to months of banks, lawyers, and regulators picking through its accounts. A reverse takeover skips that entirely. Wirecard arrived on the Frankfurt Stock Exchange without ever once having submitted to the single process designed to check whether a company is what it claims to be. Nobody stopped it because nothing was broken. That is the shape of this whole story. Not rules being smashed, but rules that were never written for the path being taken. And it worked. By 2006, Wirecard was in the Tech DAX, Germany's technology index. In 2007, EY signed off its accounts and Wirecard bought a small bank. That last detail is easy to skim past, and it is the most consequential sentence in this chapter. Wirecard was now a payment processing company that also owned a licensed German bank, which meant it was regulated two different ways at once. Germany's financial regulator, BaFin, supervised the bank inside the group. But it did not supervise the parent company, because the parent counted as a technology firm. A gap had opened between two filing cabinets. For the next 13 years, almost everything anyone worried about would fall neatly into it and land on nobody's desk. Chapter 2. The partners who weren't there. By the middle of the 2010s, Wirecard's reported numbers looked spectacular. Revenue climbing 30 and 40% a year. Wide margins. A German technology company that was finally beating Silicon Valley at something. But if you looked at where the profit was actually coming from, most of it was not coming from Germany or Europe or anywhere that Wirecard visibly operated. It was coming from three companies you have never heard of in three cities: Dubai, Manila, and Singapore. They were called Al-Alamam, PayEasy, and Senjo. Wirecard's explanation for them was, on the face of it, perfectly reasonable. To process card payments inside a country, you generally need a license in that country. Wirecard did not hold licenses everywhere, so it used partners. Local firms that already had the licenses would handle the transactions, keep a cut, and pass Wirecard its share of the fees. The industry term for this is third-party acquiring. Think of a delivery company with no vans of its own in Asia. It hires local drivers, the drivers do the deliveries, and they send most of the fare back to head office. That is the model. It is a real model. Other payment companies genuinely use it. The question was never whether such an arrangement could exist. The question was whether Wirecard's particular version of it did. Because by 2019, the Financial Times reported that those three partners accounted for roughly half of Wirecard's worldwide revenue and very nearly all of its profit. Sit with that number. Half the revenue of a company soon to be worth more than Deutsche Bank was being generated by firms Wirecard did not own, in places Wirecard did not operate, using systems Wirecard could not see. And there was a second layer on top of it. The partners did not send the cash straight to Munich. Wirecard's share was held for it, abroad, in what are called escrow accounts. Escrow simply means money held by a neutral third party until both sides agree it can be released. It is the same idea as the deposit a solicitor holds when you buy a house. Nobody can touch it unilaterally. So Wirecard's single largest asset, well over €1 billion of it, was cash that Wirecard did not hold, in accounts Wirecard did not control, at institutions Wirecard did not own, in countries Wirecard was not licensed in. Now, how do you prove money like that exists? You ask for a letter. The party holding the cash writes to your auditor confirming the balance. That letter is the evidence. That letter is the asset. A letter, signed, stamped, filed, and accepted. And for years, nobody in Munich and nobody at the auditor picked up a telephone, called the bank directly, and asked whether any of it was true. Journalists did go and look, though, not at the accounts, at the partners themselves, and what reporters found when they turned up at the addresses is one of the strangest details in modern finance. PayEasy Solutions, one of the firms supposedly generating hundreds of millions of euros in profit, shared an office in Manila with a tour bus company. Another affiliate's registered business address turned out to be a private house in the Philippine countryside, the home of a retired seaman who appeared to have no idea what the company was or that it was using his address. Investigators later concluded that the profits attributed to Dubai, Singapore, and Manila were largely invented. Wirecard's insolvency administrator eventually put it in plain language. The assets, in the billions, were simply fictitious. But that conclusion is 6 years away. In 2018, none of it was proven, and Wirecard was about to be officially declared one of the 30 most important companies in Germany. Chapter 3. Germany's Champion. To understand what happens next, you have to understand what Germany badly wanted at that moment. Germany builds the best machines in the world. Cars, turbines, chemical plants, precision tools. What it did not have, and desperately wanted, was a technology company that mattered on a global scale. America had PayPal, Google, Amazon. Germany had SAP, and after that a long and slightly embarrassing silence. Every year the newspapers asked the same question: where is our technology champion? And then, apparently, there was one. Wirecard's share price climbed from under 10 euros in 2012 to more than 195 euros by early September 2018. At that price, the company was worth roughly 24 billion euros, more than Deutsche Bank, a bank that had been in business since 1870, with branches on the high street of every German city. On the 24th of September 2018, Wirecard entered the DAX, the index of Germany's 30 largest listed companies, the German equivalent of the Dow Jones or the FTSE 100. And because the index holds a fixed number of companies, one had to be removed to make room. The company Wirecard replaced was Commerzbank, one of the oldest banks in the country, pushed out by a firm from Aschheim. That is not just symbolism. Entering the index changes who owns you, mechanically. Index funds, the passive pension and savings funds that simply hold whatever is in the index, are now obliged to buy your shares. They do not read your annual report. They are not permitted to have an opinion. If it is in the DAX, they buy it, in proportion, which meant millions of ordinary German savers now owned Wirecard, whether they had heard of it or not. And not only German savers. Every global fund tracking European or German equities now held a slice of it automatically. Index membership is a machine for converting a company's story into other people's retirement money. The professionals who were paid to have opinions were not much more skeptical. In September 2019, 8 months after detailed fraud allegations had been published, Goldman Sachs still rated the stock a conviction buy. 5 months earlier, in April 2019, SoftBank, the Japanese investment giant, had announced it was putting 900 million euros into Wirecard, a global endorsement arriving at precisely the moment serious doubts were surfacing. Read the structure of that deal, though, and it looks less like a vote of confidence. SoftBank's money came in as a convertible bond, a loan that turns into shares if the share price rises far enough. Then, 5 months later, that debt was repackaged and sold on to other institutional investors through Credit Suisse. SoftBank kept the potential upside and handed the risk of the loan to somebody else entirely. When Wirecard collapsed, SoftBank was largely insulated. The institutions holding the repackaged paper were not. Neither were buyers of a separate 500 million euro Wirecard bond, which fell below 30 cents on the euro. So the smartest money in the room had, in effect, taken the endorsement fee and left the risk on the table for everyone else. And the endorsements went higher still. In September 2019, the Chancellor of Germany, Angela Merkel, raised Wirecard's case on a state visit to China. She had been briefed by Karl Theodor zu Guttenberg, a former German defense minister, by then working as a consultant with Wirecard as a client. Internal documents later obtained by a transparency organization show Gutenberg wrote to a Merkel advisor saying he had met the Chancellor that afternoon, that a brief mention during the visit could be very helpful, and that she had asked him to supply the wording. Merkel later told a parliamentary inquiry that Wirecard had received no special treatment and that promoting German companies abroad is a normal part of the job. Both of those things can be true, and it is still a remarkable sentence. The Chancellor of Germany carried a talking point, drafted by the company's own lobbyist, on behalf of a company whose accounts a major newspaper had already reported were fabricated. Chapter 4. The Reporter, the Lawyer, and His Mother. In 2014, a journalist at the Financial Times in London received a tip. His name was Dan McCrum, and the tip was vague, something about money laundering at a German payments company. He started reading the accounts, and the first thing that struck him was not a crime at all. It was a shape. Wirecard kept buying small companies in faraway places at prices that looked high. The acquired businesses kept underperforming afterwards, and yet the group's reported profits kept climbing anyway. Acquisitions are useful to a fraud for a specific and slightly technical reason. When you buy a company, accounting rules let you book a large subjective number for the things you cannot physically touch. Brand, customer relationships, goodwill. A number that nobody can independently check is a number that nobody can disprove. And if you have invented profits, they have to end up somewhere on the balance sheet. Buying things is how you make them disappear into an asset. McCrum published his first series in 2015. He was not the only one circling. In 2016, an anonymous outfit calling itself Zatara Research put out a report alleging fraud, and the share price crashed. And here is the first clear sign of what this story actually is. Germany's financial regulator opened an investigation into the people who had published the report for market manipulation. That logic is not insane on its face. Some short sellers really do publish exaggerated claims in order to profit from a fall, and regulators are right to care about it. Short selling, if you have not met the term, it means betting that a share price will go down. You borrow shares, sell them today, and hope to buy them back cheaper later. It is legal, and it is deeply unpopular. But look carefully at what the regulator did with the allegation. It investigated whether the accusation was a crime. It did not, in any comparable way, investigate whether the accusation happened to be true. Meanwhile, the information that would eventually break the company open was not in London at all. It was in Singapore, in the files of a lawyer in his 20s. His name was Pav Gill, and he was legal counsel for Wirecard's Asia-Pacific business. In 2018, colleagues began describing things to him, in writing, that sounded very much like accounting fraud. They described contracts that had been forged, dates that had been backdated, and money moving in circles, out of Wirecard's own subsidiaries, through outside firms, and back again, arriving home looking like brand new revenue. That particular trick has a name: round tripping. Picture paying a friend 100 euros, the friend paying it to your brother paying it back to you, and all three of you then reporting 100 euros of sales. Nothing was sold. Nothing was earned. But three separate sets of books now show revenue, and each set, examined on its own by a local auditor who cannot see the other two, looks entirely normal. Gill did what a competent in-house lawyer is supposed to do. He commissioned an outside law firm to investigate internally, and he escalated what they found. And then the pressure came down on him. He was pushed out of the company. By his own later account, he was left frightened, unemployed, and holding a stack of documents that nobody seemed to want. What happened next is the part of this story that tends to stay with people. His mother refused to let it go. She approached a major American newspaper anonymously, offering the evidence. She never received a reply, so she contacted a journalist known for exposing an enormous Malaysian corruption scandal and kept going. Through that chain, the documents reached the Financial Times. A mother in Singapore, emailing strangers on behalf of her son, put the file into the hands of the one reporter on Earth who had already spent 4 years looking for exactly it. In 2018, McCrum also received a second cache, around 70 gigabytes of correspondence from a former Wirecard lawyer. Months of reading followed, cross-checking names, dates, and numbers against everything already gathered. And on the 30th of January, 2019, the Financial Times published a named senior executive, forged contracts, backdated documents, 37 million euros round, tripped across 7 separate sets of transactions. The share price fell more than 13% in a day. 2 weeks later, police in Singapore raided Wirecard's offices there. Whatever else was in dispute, the story was now unambiguously real. It is worth marking how long that took. 5 years from the first tip to the story that finally moved the share price. 5 years of one reporter at one newspaper on one company with no guarantee of being right. That is the honest cost of finding a fraud this size from the outside. And it is why the next thing that happened matters so much more than it sounds. Chapter 5. The day the referee joined in. What should happen at this point is obvious. The regulator reads the reporting, looks at the underlying documents, and opens an investigation into the company. On the 18th of February 2019, Germany's regulator did something else. It banned investors from betting against Wirecard shares. Not a trading halt, not a suspension pending an audit. A legal prohibition on taking new short positions in one single company's stock in force for 2 months. Germany's market regulator had never done that for an individual listed company before. It has not done it since. Wirecard is the only one. And the obvious objection here is that this was one national regulator making one bad call. It was not. The ban had to be reviewed by Europe's own markets authority, ESMA, and ESMA approved it. In its formal opinion, ESMA agreed that the circumstances around Wirecard posed a serious threat to market confidence in Germany, and that banning short sellers for 2 months was appropriate and proportionate. So the official European position in February 2019 was that the people betting against Wirecard were the threat to confidence. Not the accounts, not the forged contracts, the people pointing at them. Now think about what a short seller is, even at their least sympathetic. A short seller is somebody with a direct financial incentive to go and find fraud. That is genuinely, structurally, all they are. Because look at who else is in the room. The auditor is paid by the company it audits. The analysts are paid by banks that sell the company's shares. The index buys it automatically. In that room, the short seller is the only participant who makes money if the bad news turns out to be true. And the regulator removed them from the board for 2 months. And then it did the other thing. BaFin filed criminal complaints against 2 Financial Times journalists, Dan McCrum and Stefania Palma, on suspicion of market manipulation, on the theory that they might be coordinating with short sellers. The German state had now formally accused reporters of a crime for publishing documents which were, as everyone eventually agreed, accurate. Prosecutors dropped the case in September 2020, 3 months after the company had already collapsed. If a regulator investigating the messenger instead of the message is the kind of story you want more of, subscribing genuinely helps this channel keep making them. And there is more of this one to come. Because Wirecard was not only relying on the state to handle its critics, it was running an operation of its own. The company engaged Rami El Obeidi, a former head of foreign intelligence for Libya's transitional government, to look into the people questioning its accounts. Under him, private investigators mounted a surveillance operation against financiers in London, including the hedge fund manager Crispin Odey, who had publicly bet against the stock. El Obeidi later admitted funding operations in London that he acknowledged may have involved phone tapping and hacking. Journalists reported being physically followed, their homes and offices watched, phishing emails arriving, precisely tailored, designed to open their accounts, stories appearing about their private lives. And this was not paranoia, because it was eventually proven in a courtroom. In 2023, a court in the United States sentenced a hacker for hire named Aviram Azari to 80 months in prison. Among his targets, Wirecard's critics. So consider honestly the position of a journalist in London in 2019. You are being tailed. Your email is under sustained attack. Your evidence is solid. Your editors are exposed to a libel action in 2 countries. And the company's own national regulator has just reported you to the police and made it temporarily illegal to bet against the firm you're saying is a fraud. There is a reason essentially nobody else pursued this story. It was not that the fraud was undetectable. It is that detecting it was extraordinarily expensive, and being right offered no protection whatsoever. Meanwhile, underneath all of it, the entire structure still rested on one kind of document. Not a bank statement, not a wire transfer record, a letter. And in January 2026, a court in Singapore finally put an exact number on how many of those letters there were. Chapter 6. 13 letters. Every year, an auditor has to verify that the cash a company says it has actually exists. For an ordinary business, this is close to trivial. It is one of the simplest checks in the entire audit. The auditor writes to the bank. The bank writes back, independently and directly, confirming the balance. Crucially, the confirmation is not supposed to travel through the company, because that would defeat the entire purpose of asking. Wirecard's escrow money was confirmed by letters from a small Singapore firm called Citadel Corporate Services, which acted as the trustee holding the cash. In January 2026, a Singapore court sentenced its director. He had issued 13 confirmation letters between March 2016 and April 2018, falsely stating that Citadel was holding over 1.1 billion euros of Wirecard's money. He was sentenced to 10 years in prison. A British businessman convicted of instigating 5 of those letters received 6.5 years. 13 letters. That is what a billion-euro asset on the balance sheet of a company inside Germany's premier stock index physically consisted of. Wirecard's auditor was EY, one of the 4 largest accounting firms in the world, auditing a substantial share of the planet's major companies. It signed clean opinions on Wirecard for 2016, 2017, and 2018. Germany's audit oversight body later found that EY had breached its professional duty in all 3 of those years. In 2023, it fined the firm 500,000 euros and barred it from taking on new listed clients in Germany for 2 years. Individual auditors were fined between 23,000 and 300,000 euros. 500,000 euros for signing off nearly 2 billion euros that was not there. It is worth knowing what an audit is actually for, because the answer is narrower than most people assume. An audit is not a fraud investigation. It is an opinion, issued to a standard, that the accounts are free of material misstatement, and it is commissioned and paid for by the very company being examined. That is the structural problem in one sentence. The customer of the audit is the company. The beneficiary of the audit is the public. And when those two disagree, only one of them is paying the invoice. By early 2020, the pressure had built enough that Wirecard's own supervisory board did something unusual. It hired a second accounting firm, KPMG, to investigate the allegations and clear the company's name. This is a standard corporate maneuver. You commission an independent review. The review finds nothing, and you waive the report at your critics for the next 5 years. Wirecard's management publicly welcomed it. The report landed on the 28th of April, 2020. It did not clear anything. KPMG said it could not verify the majority of the revenue from the third-party partners across 2016 to 2018. Roughly €1 billion of transactions it was simply unable to check. And it explained why. Wirecard had not handed over documents that were requested, or had handed them over months late, delaying the entire investigation. Read that back slowly. The company hired investigators to prove it was honest, then withheld evidence from its own investigators, and those investigators said publicly that they could not confirm the profits existed. The share price fell 19% that day. Then it recovered. Analysts kept their buy ratings. The index kept it. The passive funds kept buying it automatically on behalf of other people's pensions. Every institution in the chain had now been told, by a source none of them could dismiss, that the money might not be there. 7 weeks later, somebody finally asked the bank. Chapter 7. 10 days in June. The 2019 annual report had already been delayed 3 times. EY now wanted real evidence of the 1.9 billion euros sitting in escrow, not a trustee's letter. Confirmation from the banks themselves. The money was said to be held at 2 institutions in the Philippines, BDO and BPI, 2 of the largest lenders in the country, real banks with real branches, real regulators, and real reputations. On the 18th of June 2020, EY refused to sign. It stated that it had been unable to obtain sufficient audit evidence that the money existed. Wirecard's shares fell more than 60% in a single session. Several billion euros of market value gone before lunch on the auditor's sentence alone. And then the banks themselves spoke. BDO told the Philippine Stock Exchange in writing that the document claiming the existence of a Wirecard account with BDO was a falsified document and that it carried forged signatures of bank officers. BPI said essentially the same and suspended an employee. BDO dismissed a marketing officer who had fabricated a bank certificate, a certificate that had been supplied to EY in Germany. Then the governor of the Philippine Central Bank said the sentence that ended the argument entirely. There was no evidence that the money had ever entered the Philippine financial system in the first place. Not that it had left, not that it had been stolen or spent or hidden, that it had never arrived. $2 billion had not gone missing from the Philippines because $2 billion had never been in the Philippines. Somewhere inside this same window, Jan Marsalek, Wirecard's chief operating officer, the executive who ran the Asian business the entire fraud depended on, was removed by the board. And then, he was gone. Reporters later reconstructed the route, a flight to Tallinn in Estonia, then a private aircraft. On the 19th of June, it landed in Minsk in Belarus, reportedly arranged with help from an intelligence contact and a far-right Austrian politician. On the 22nd of June, Wirecard issued a formal statement to the markets. It is worth hearing the exact wording because every word of it is doing careful legal work. Quote, "The management board of Wirecard assesses on the basis of further examination that there is a prevailing likelihood that the bank trust account balances in the amount of 1.9 billion euros do not exist." End quote. A prevailing likelihood that the money does not exist. That is a listed company, in public, in the most cautious language its lawyers could construct, conceding that its largest asset was fictional. Marcus Braun was arrested the same day, and the head of the regulator that had banned people from betting against the company and had reported the journalists to prosecutors offered his assessment of the situation. Quote, "It's a complete disaster we're looking at," said Felix Huffeld, the president of BaFin. "It's a shame that something like that happened." End quote. He added that a whole range of private and public entities, including his own, had not been effective enough to prevent it, which is true and remarkably incomplete. BaFin had not merely failed to prevent the fraud, it had actively removed the two forces in the market that were trying to expose it and pointed the criminal law at one of them. On the 25th of June 2020, Wirecard filed for insolvency, the first company in the history of Germany's premier stock index ever to do so. 9 months earlier, a chancellor had promoted it on a state visit. 21 months earlier, it had displaced a 150-year-old bank from the index. Now, it was worth nothing, and the index quietly removed it. And on the 26th of June, the consequences finally reached the people this film opened with. Britain's regulator froze Wirecard's UK card subsidiary. Every card it issued for other companies stopped working at once. Curve, Pocket, Anna, FairFX, Payoneer, Crypto.com. Hundreds of thousands of people instantly locked out. These were not Wirecard's shareholders. Most were prepaid card customers. Very often, people who used those cards precisely because opening a normal bank account was difficult for them. People on low incomes. People whose state benefits were paid onto the card. They were told to contact local welfare schemes if they could not buy food. The card started working again 4 days later. For those 4 days, a fraud in a Munich suburb determined whether people in Britain could eat. That is the answer to the question this film opened with. The invisible layer is invisible right up to the exact moment it fails. Chapter 8. The Bill and the Man in Moscow. So what was Wirecard actually worth? We have an unusually precise answer to that because the real business, the part that genuinely existed, was eventually sold to somebody. In November 2020, Santander bought Wirecard's core European payments business and technology platform, taking on around 500 employees. The price was 100 million euros. A company the market had valued at 24 billion euros left behind a genuine, functioning business worth about 100 million, roughly 0.4% of the peak valuation. Everything else, the growth story, the margins, the Asian empire, the reason it was in the index at all, was the letters. The bill for that has now been distributed with considerable precision, and almost none of it has landed on the people who wrote the letters. In November 2025, Germany's Federal Court of Justice ruled that shareholders' damages claims rank behind all ordinary creditors in the insolvency. The arithmetic is brutal. Around 8.5 billion euros of shareholder claims. Around 650 million euros of assets in the estate, which the ordinary creditors have first call on. In practice, shareholders recover nothing. And remember who those shareholders include. The passive index funds that were required to buy the stock the moment it entered the DAX, which means German savers who never chose Wirecard and never heard of it helped pay for it. And the people who actually built the thing lost their jobs. Wirecard employed somewhere around 5,000 people across the group, 1,300 of them at the head office outside Munich. Within weeks of the insolvency, 730 of the remaining staff were terminated, more than half of what was left. Almost none of them had any idea what was in the Asian accounts. The regulator's president and his deputy both left in January 2021. EY received its 2-year ban and its fine, and now faces a claim of around 1.5 billion euros from the insolvency administrator. Europe's Markets Authority, the same one that had approved the short-selling ban, went back and reviewed how Germany had supervised Wirecard. Its findings are worth stating precisely. It reported that the frequency and detail of BaFin's reporting to the Finance Ministry raised the risk of ministry influence over the regulator's actions. And it noted that members of BaFin's own market abuse team had been trading Wirecard shares. The unit responsible for detecting market abuse in Wirecard stock contained people who personally owned Wirecard stock. That is not a conspiracy. It is something much more ordinary and much harder to fix. In Munich, the criminal trial of Markus Braun has been running since December 2022, more than 270 days of hearings. He has been in custody for 6 years, and he denies everything. His defense is that he was himself a victim, that Marsalek and others ran a shadow structure inside his own company, hijacked the payments business, siphoned off the proceeds, and deceived him exactly as they deceived the auditors. The prosecution's central witness is Oliver Bellenhaus, who ran the Dubai operation, has confessed and told the court that Wirecard was a scam, with Braun at the core of everything. Braun's lawyers respond that Bellenhaus is not a witness at all, but a principal offender in a group whose only aim was to steal. The court will decide which account it believes. Closing arguments are scheduled for late October 2026. A verdict is expected after that. German reporting suggests Braun should expect a sentence of more than 10 years, which leaves the man who actually built and ran the machine. Jan Marsalek has never been arrested. He is wanted by Interpol, with a reward offered by Germany's federal police for information leading to his capture. A joint investigation by PBS Frontline, The Insider, Der Spiegel, and ZDF reported that he has been living in Russia under a new identity, the name Konstantin Byazov. Accounts differ on exactly where, and this is the point where the story stops being about accounting at all. In March 2025, a court in London convicted 6 Bulgarian nationals of spying for Russia. Marsalek was named in that courtroom as the ring's mastermind and its handler, working, investigators said, for Russia's Domestic Intelligence Service, the FSB, and at times for its military intelligence, the GRU. Investigators also established that back in 2018, while he was still a serving executive of a DAX company, Marsalek showed contacts in London for classified documents from the international investigation into the Novichok poisoning of Sergei Skripal, including, reportedly, the chemical formula of the nerve agent itself. The chief operating officer of one of Germany's 30 most valuable public companies, a firm whose systems touched the card payments of millions of ordinary consumers, was carrying nerve agent documents around London. In November 2025, he was named as a suspect in a separate €300 million fraud investigation. He remains at large today. It is tempting to file Wirecard under clever criminals. It does not really fit. The fraud was not sophisticated. It was 13 letters, some companies sharing an office with a bus firm and a retired Siemens house. The sophistication was never in the deception. It was in the incentives arranged around it. The auditor was paid by the company it audited. The analysts were paid by banks that sold its shares. The index bought it automatically with other people's pensions. The government wanted a national champion badly enough to carry its talking points abroad. Everyone in that chain was, in a small and individually defensible way, rewarded for believing. And the only two groups rewarded for doubting, short sellers and investigative journalists, were investigated, banned, followed, and hacked. A junior lawyer, his mother, and one reporter ended up doing the job that an entire regulatory apparatus was funded to do. It took 6 years, and it very nearly destroyed all three of them. Germany did change the rules afterwards. A law passed in 2021 forces listed companies to change auditors after 10 years, bars the auditor from selling them consulting work, and gave BaFin far stronger powers to search, seize, and demand documents. But the deepest incentive was left standing. The auditor is still selected and paid by the company it audits. The index still buys whatever qualifies, and the plumbing is still, by design, invisible. There are more payment companies inside your daily life today than there were in 2020, and you can probably name none of them. That is not a scandal. It is just the condition. And you still find out who was really holding your money on the morning your card stops working.